More than half of all candidates fail the Florida real estate exam on their first try. It's not because they didn't study, it's because they studied the wrong way. State exam questions are designed to trick you into second-guessing what you already know. But with the right Florida real estate exam prep, you can walk into your test knowing exactly what to expect. In this video, you'll hear from a licensed Florida real estate instructor who's going to walk you through exam-style questions, breaking down each one so you understand the logic behind the answers. Let's get started.
All right, so we're going to start out with this question, and this may be a question you start out with on your real estate exam, right? So you may start out with an immediate math problem, just like that, right? All right, so a house cost $89,500 to build. When new, the building was estimated to have a 50-year-old useful life, or 50-year useful life. Using the straight line depreciation method, doesn't say method, but that's what they're asking. What is the accumulated depreciation after 4 years? Accumulated. Now watch, everybody take a look up here at the camera. This is a real estate calculation that talks about depreciation. Okay. Now let's just converse a little bit about depreciation before we put any pencils and calculators to this. When we talk about depreciation, we're referencing investment properties. Okay. That's one aspect of using depreciation. Another aspect of using depreciation is an appraiser that's valuing property that's a special purpose building, like a post office, a library, right? They're going to use the cost approach. In that cost approach, after they get the cost of rebuilding it brand new, they're going to depreciate it. They're going to use this method to depreciate the building to get a valuation, okay? In this problem, they're just asking you to use a straight line depreciation method, okay? Now, they give you the useful life of the structure, okay? They said it's a house, 1. 2, they give you 50 years. If, in fact, you see a problem on the state exam, pay attention to this, and it doesn't say a useful life, you have to know that the IRS uses 27 and a half years for residential and 39 years for commercial. Okay, 27 and a half and 39. So if you don't see anything like that, and you see just a description of a building, it may not say a house. It just may say an apartment or a building, right? If it says a building, you got to understand that talking about commercial. So unless they identify residential as residential, then you're looking at commercial, okay? Again, they give you the useful life here, 50 years. Now, there's a couple of ways you can work this problem using the straight line depreciation. I can take one year and divide it by 50, okay? And you ought to have a calculator with you. All right, so if I go 1 divided by 50, I've got 0.02 per year, it'll depreciate, or 0.02% per year, it'll appreciate. If I add up 50 years, then I'm going to get a whole 50-year useful lifetime. Okay, so for each year, it's going to depreciate 0.02. Okay, all right. So if I take 0.02 and I multiply it by 89,500 times 89,500. I'm going to get $1,790 per year. It's going to depreciate. Well, they want to know what the accumulation is. So I do times 4, and I see this is going to depreciate a total of $7,160. So we're looking at answer A, okay? So that's the straight line depreciation method, all right? It's just straightforward. They're giving you everything in the question. So let's go and take a look at it. All right, let's circle back and revisit. Remember, the IRS code, if you look under 1A, 1 and 2, is 27 and a half years and then 39 years. If you're not given the years in this in the problem to depreciate, you have to go with these constants, okay? Again, this is used in this method is used for investors to be able to depreciate property. Here's how this theory works. Watch, look up here for a second. Look up at the camera or look up at the screen. Here's how they use this method. And you might ask me, John, I thought you said real estate appreciates, and it does go up in value. But what the IRS does for the investor is they allow them to depreciate it so they can collect from the government that amount of depreciation per year in tax revenue or tax credit. What does that do? It allows them to keep more money in their pocket, okay? But what the IRS says is that each year, $1,790 per year in this problem, the IRS says we're going to allow you to keep, to put it into the property, to maintain it. If you look at the two houses below, you got one on the left, you can see the shape it's in, and then you can see after 50 years, there's no maintenance put into it, what it can actually go to, okay? So that depreciation is an input or an infusion of money to maintain that the government allows you to do, okay? So it's actually a tax credit to put towards your property. Do you have to use it? No, they still give you the tax credit, okay? So let's look at the problem.
Ready to pass the Florida Sales Associate, Broker, Mutual Recognition, or Endorsement State Exam on your first try? Get our exam prep database that contains practice exams tied to over 1,000 exam-style questions with detailed explanations. Enjoy 3 months of 24/7 access from any device, including desktop, laptop, tablet, and mobile. Click here and use the coupon code YouTube to get a special discount.
Cost $89.5. 50-year, we said, useful cycle. Got to use a straight line depreciation method. We're looking for accumulated depreciation value after 4 years, not per year, not for 50, after 4 years, okay? So again, I can work it one of two ways. I can take the 50 years and divide it into 89.5, and I get $1,790 per year. Times 4 gives me $7,160. Or I can take 1 divided by 50, or 1 year divided by 50 gives me 0.02% per year. It will depreciate times 4 years will give me 0.8 times 89.5 will give me 7,160. So 2 ways you can work it there, okay? And that's called straight line depreciation method. Question number 2, which statement regarding the division of real estate, DRE, is false? Is false. Okay, so take a couple seconds and look at this. Talking about the division of real estate. What you have to understand about DRE is how is the umbrella set up? I call it the umbrella, DBPR, and then what hangs or suspends below DBPR, the Department of Business and Professional Regulations, okay? So what hangs below DBPR? Well, you got DRE and FREC and, some other things. So you have to kind of understand that structure. And so looking for a false statement, just go through each one and answer them, okay? The director of DRE is appointed by the FREC chairman, okay? That's just something you have to know, right? So that's a true statement, okay? The DRE director, the director of DRE is appointed by the FREC chairman. DRE offices are located in Orlando. The Department of Business and Professional Regulation employs DRE personnel to support FREC activities, and DRE's ministerial duties involve record keeping. So we're looking for a statement regarding DRE, which is false. DBPR is known for the Department of Business and Professional Regulations. And so you got different types of Florida statutes. 120 talks about licensing and disciplinary process when it comes to licensees, strictly for that. 455 is regulating businesses and professionals in Florida. So that's an entire scope of all the different licenses one can hold. 475, Florida statute, that's our real estate licensing law. And then 61J2 is the Florida Administrative Code. That's what FREC. Remember, they're a quasi legislation. They make rules and regulations too. And then under DBPR, it's broken into divisions. Okay, you got the Division of Professions, and then you got DRE. Okay, again, located in Orlando. Administration for Real Estate License Law supports FREC in active activities and duties, including administrative. The DRE director is appointed by not FREC, but the DBPR secretary. Okay. So that's what makes A false. Okay. So the DRE director is appointed by the DBPR secretary. It's approved by FREC. Okay. So you got to read that question under A. Under A, it says, which statement is false? And so the reason this is false is because the DBPR secretary appoints the DRE director. It's approved, almost like a confirmation, right? So it's kind of a confirmation that FREC does. So FREC does not appoint the chairman. It's actually the DBPR secretary. Okay. All right, here we go. And here's a little umbrella I put in. Remember DBPR, and then you got DRE and FREC. Again, appointed by the DBPR secretary and confirmed or approved by the Florida Real Estate Commission. All right. A married couple purchased a home for $287,500, made a down payment of 25%, and secured a new non-conventional mortgage loan for the balance. Calculate the intangible tax due. Okay. Remember, theory-wise, we don't pay state tax to Florida. Florida doesn't charge a state tax. So they have to collect some type of revenue to support their infrastructure at the state level. And so the way that's done is through real estate transactions. So 3 taxes one time is charged at the act of sale. So you got the deed transfer, you got the, which is what they're asking here, the intangible tax, which is the mortgage tax. And then you've got the promissory note or the note tax, okay? And so those 3 are charged at the act of sale, all right? So let's go ahead and look at this problem. Now, what you have to know about the deed stamp tax, and if you want to take a picture of it, a nice little shortcut, little memory aid for those who want to have something like this. Remember, the deed stamp tax on line 2 is paid by the seller, and it's on the sales price one time at the act of sale. AOS is act of sale, okay? And the way you calculate it is you got to take 70 cents per 100 stamps, okay? And to determine the stamps, you got to take the sales price divided by 100. And so it's either going to be a whole number, it's always going to be a whole number, but if you come up with a fraction, you have to round up to the next, okay? Remember, you can't use a partial or half a stamp, right? So you're always going to round up to the next whole number if it's a fraction. No matter if it's less than 5 or greater than 5, it's always going to go to the next higher number, okay? And so it's the number of stamps times 0.70 or 70 cents. Then the note tax, same way to calculate it as a D stamp tax, except you're going to use 35 cents, so half, right? Half. Same thing, but it's paid by the buyer. And it is not on the sales price, but the loan amount, okay? And then the intangible mortgage tax is just a straight 0.002 times the loan amount, okay? Again, paid by the buyer at the act of sale one time. All right, so here's the problem here. All they want to know is the intangible, right? Intangible mortgage tax, which is 0.002. Couple purchased a home for $287,500, made a down payment of 25%. So there is a little bit of a calculation you have to do because you're only looking for the loan amount. So you can't tax any money they put up front or put down on the home. So if you put 25% down, then they're going to finance 75%. So if you look at the equation, I got $287,500 times 0.75 or 75%. So they're going to finance $216,625. And just multiply that loan amount by 0.002, and you get $431.25. Okay. All right, pretty simple. Again, the rest of the taxes, you just got to look at the problem. Sometimes they'll give you a problem like this with a few other numbers, and they want you to do all 3 of them. Okay. All right. Which statement is false regarding unearned fees? Unearned fees. Again, my technique, the way I do this is if I say which one is false or which one is true, either way, I usually go through and answer each question, true or false, right? And that'll give me the answer, okay? So which statement is false regarding unearned fees? What do y'all think? Okay. All right. So if we look at this, the false statement we're looking at is answer A. Watch this. Real estate licensees are prohibited from sharing their commission with the buyer or seller in a real estate contract unless the buyer or seller is a real estate licensee. And that's false because they don't have to be licensed for you to share your commission for closing costs or a gift or something like that. So buyer and seller is always an okay thing, even if they're not licensed. Okay. B is a true statement because if someone lives in an apartment building, they can find, again, if they live in the apartment building, got one owner owns the apartment building, they're an actual renter, they can get a $50 referral fee if they find someone for that building, okay? And payment of an unearned commission must not violate RESPA, Real Estate Settlement Procedure Act, and that's true. And then anything unearned fee is also called a kickback, okay? So the false statement we're looking at is answer A.
For more practice questions, videos, and insight into the state exam, we encourage you to join our free exam prep webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Click here to get registered.
All right, so unearned fees, eligibility for a commission. You have to be licensed. You can't share a commission with anybody that's unlicensed. Remember the area code 355? A third-degree felony, up to 5 years in prison, up to $5,000 in damages, okay? Remember the area code 355, okay? Unlicensed, third-degree felony. Third degree is the first three of the area code. The 5 is up to 5 years, and the other 5 is up to $5,000, okay? Or both, all right? Not necessarily 5 or 5,000, but up to that and including both, okay? So that's what defines third-degree felony. 355, that's the area code, okay? All right, so unlicensed people cannot share a commission with an unlicensed person other than your client that you serve, buyer or seller. Cannot earn fees paid to a licensee associated with a real estate transaction for non-real estate services, okay? You can never get paid for anything that's outside of real estate services, okay? Your broker always gets paid, but remember, a bar sale is that acronym we use when it comes to the real estate services, right? A bar sale, okay? And this would be known as a kickback. Kickbacks are prohibited with RESPA. Remember, kickbacks usually happen with professionals, like an appraiser may do an inflated appraisal cost, and the bank may give them a kickback, but who ends up paying for it, right? It's a violation of RESPA. It always falls on the buyer, okay? Again, 475 does allow for an apartment building tenant to get $50 for referring in that building, okay? So we're talking about unearned fees. All right. The sellers are asking $144,000 for their 1,800 square foot home. What's the asking price per square foot? Okay. Real basic geometric problem. They give you the square feet. They give you the price of the home. So it's really just a simple division problem. Okay. So what do you think it is? Go ahead and work it out. All right. So we're talking about in the real estate calculations, what a geometric figure is. Now they give you the square feet, right? But if not, they may give you a length times width, all right? Or length of the house and the width of the house, okay? Or it may be a lot, you know, this may not be a house, but a lot. They may give you a frontage, which is the frontage road, and then the depth to the property, okay? In any case, we're talking about square, rectangular, length times width will give you the square footage. In this case, they already give it to you, okay? And it's just a simple division. 144,000 divided by that gives you $80 a square foot. All right, next question. If a licensee accepts a post-dated check as earnest money deposit on real property, which applies? So, in other words, the question's asking if you're dealing with a buyer and we put an offer in and the buyer puts an offer in on a property and they accept it and they give you a deposit check and they say, look, tell them to post date this so I can have funds. What must be done according to 475? Okay. The seller must approve it first. Okay. And that's exactly right. So when we talk about escrow or trust accounts, earnest money, obviously, that's money that belongs to the transaction. Okay, so it usually comes from the buyer, but it belongs to the transaction, and that's what it's in connection with. Remember, it's deposited into an escrow account, okay, which is usually a non-bearing interest account when we're talking about residential. It can be interest-bearing, but approval has to be done by all parties. You can actually open an escrow account for one transaction and make it bearing interest. You know, you may say, well, John, when is that done? Well, you know, take, for example, if there's a huge commercial property being sold, talking tens of millions of dollars in value, and it's going to take 2.5 years to do this, and they're gonna pull together, you know, $800,000 million deposit, then you want to put that in an interest-bearing account. Again, permission from everybody, in writing, approval, all that's worked out. Okay. Now, who can, as far as brokers, where can they open these escrow accounts? And we're talking about commercial banks, credit unions, savings association. There is a question out there that talks about which of the following does not allow or doesn't, by law, cannot be used to open an escrow account. And I think one of the answers is an insurance company, right? Insurance companies may have escrow accounts, but under Florida law, we can't keep deposits with insurance companies. So a brokerage firm or a broker who opens an escrow account, it's going to be a commercial bank, credit union, or savings association. Okay. Remember the collection of the deposit given to the broker by the end of the next business day. So the agent collects it today, got to give it to the broker by the end of the next business day. Now, on the test, really, if you see a question that says, when should the deposit be deposited in the escrow account? The answer is immediately. Okay. It should be immediately deposited. However, there's extenuating circumstances in the law that gives us a little bit of latitude. Again, I collect it today, got to give it to my broker by tomorrow, and then deposit it by the third business day of the initial receipt. Okay. So there's latitude to actually get the deposit into the account, but it should be put in there immediately. Post-dated checks, again, there's your answer for this one. It's got to be approved by the seller before acceptance. Okay. And then everybody recognizes the signatory of escrow account. Remember, it's a mandatory law that the broker reconciles the escrow accounts monthly. Okay. Not necessarily the broker bean counting, right? That's not necessarily what they're talking about. The broker's responsible. So there could be a CPA or a third party that does the bean counting of the reconciliation, but the broker's going to sign off. Okay. But it has to be done monthly, and it can be audited at any time, but the law says they have to do it monthly. All right. The buyers paid a cash down payment of $55,000 and applied for a $145,000 loan. What is the LTV? Okay. So we're talking about a loan to value ratio. Okay. So the buyer made a cash down payment of $55,000 and applied for a loan for $145,000. Okay. Now, watch this type of question. Okay. So just don't go and take numbers and start dividing them out. All right. You got to read the question, because there's more to this than what, as simple as it sounds, there's more to this. The first rule of thumb you have to know when calculating a LTV or a loan to value ratio is you got to understand you got to use the sales price or the appraised value, whichever's less. That's what banks use. That's what loan makers use when it comes to lending money. They're not going to lend any more money than what's under contract, which is the sales price, or what it appraises for, which can be less than the sales price. Okay. It can be more. So it would be the sales price at that point, but it's going to be the sales price or the appraised value, whichever's less. So you have to look at this problem. You know, they want an LTV. So you got to find out, what's the sales price? Well, the sales price is not a loan, right? That's a loan amount. The down payment is $55,000. So we don't have a sales price. We don't have an appraised value that we can see or that it's given to us. So we got to compute a sales price. Okay. You follow what I'm saying? So you got to be careful. Just don't start dividing numbers out, because they'll have an answer in there like that. All right. So let's look at this. Remember the rule of thumb: appraised value or sales price, whichever's less. So let's look at this. Down payment, $55,000, and the loan value is $145,000. So I know I got to determine. They don't give me an appraised value, and of course I can't determine that, but I can determine what a sales price is based on these two numbers I got. If I add them together, the down payment plus their loan value, I'm going to get $200,000. That is the cost of the home. It's $200,000. Okay. Now, if I take the loan value divided by the sale price of the home, I get 72.5%. Okay. Does that make sense? Everybody see what I'm talking about? You got to be careful, because a lot of times you're going to see numbers and you're going to say, oh, okay, LTV, let's see, down payment looks good. 55,000, looks good. Next thing you know, I get 37.9%. And I think that may have been an answer. Yep, it was. It's answer A. So if I just divide 55 by 145, I get 37.9. Okay, so you got to be careful. Look, this is a little testmanship. Let me take a little time. I want to make sure. I've been behind these computers a long time. I've been taking these tests for 20 plus years. Listen to me. You have to read the question. I can't emphasize this. I tell this to y'all every week, and I know I drive this home, but it's important. Read the question, unpack. Everybody knows my favorite terminology when it comes to this is unpack these problems line by line, because it's very easy to migrate to fall into just making a calculation. So you have to know the theory behind it, appraised value or sales price, whichever is less. And you got to look at the problem and say, well, what is my sales price? Well, there's a loan amount. That's not the sales price. They put down payment, so I got to add them together. Then I make my division. Okay. Give me a thumbs up if you understand what I'm talking about here. This is a kind of a perfect example, a good stopping point that I want to kind of make a point here when it comes to reading these type of questions. And you can see how easy it is to jump on it. All right. Which entity or individual may not be licensed under a trade name? Which entity or individual may not be licensed under a trade name? Okay, so what's a trade name? These are registered with the Florida Department of State, used for business entities. For example, corporation, LLC, LLP, okay? Can a licensee, a sales associate, a broker associate, have and register with the Florida Department of State an LLC, a corporation, an LLP? And the answer is yes, only for accounting purposes. What you can't do is you can't, as a sales associate or a broker associate, market with those names. Okay, so that's what trade names are. So no trade names used by a broker associate for sales associate for advertising. Okay, they can use a trade name under their legal name for accounting. Okay, so if you got an LLC, first name, last name, LLC, right? First name, last name, LLC. You bring it to the brokerage accountant and say, look, don't write me a check, write my company a check. Because for tax purposes, you may set up a corporation or an LLC where you take a draw from your company. So it's for tax purposes and stuff like that. Okay, keep more money in your pocket. You have to talk to a CPA about that. Okay, so real estate brokers associates are not allowed. Okay, and that's right, for advertising. All right, a married couple signed a contract to purchase a home for $280,000 and make an earnest money deposit of $5,000. Seller agreed to pay 7% commission to the listing broker. The buyer is going to receive a credit for $2,734 for the seller's portion of the ad valorem taxes. If the buyer obtains an 80% conventional 5% interest with 3 points to be paid by them, how much will be due from the buyers at closing? This is a big problem, right? A lot of numbers. This is one you always emphasize. You got to unpack this line by line, okay? So let's take a look at this. This is under the general rule of thumb for closing costs. So you want to review, in theory, what's going to be a credit to the buyer, okay? The new mortgage amount or an assumed mortgage, earnest money deposit, prorated taxes, which is paid in arrears. Remember, they get credit for that. Any type of advance rent, if it's a rental investment property purchase, and security deposit. So all these become credit to the buyer. In other words, the buyer doesn't have to bring this to the act of sale, but it's going to be a credit. Then debits to the buyer is the selling price, prepaid taxes are in advance, mortgage, and note stamp tax. That's also a debit to the buyer. Title insurance, recordation fees, both for the deed and mortgage, attorney fees, doc preps of the mortgage and the note. So all these become debits or financial charge, not financial, but debit charges to the buyer for an active sale. Okay. So you've got to unpack this. In the yellow box is the problem I put so we can reference it. So a married couple signed a contract, purchase a home, $280,000. Okay. Earnest money deposit, $5,000. Seller agreed to pay 7% commission to the listing broker the buyer will receive a credit for 2734. So it tells you there's a credit there for the buyer for the seller's portion of the ad valorem taxes. If the buyer obtains an 80% conventional loan, 5% with 3 points to be paid by them. How do you define them? I'm assuming that's the seller. How much will be due from the buyer? So let's unpack this. What's going to be a credit to the buyer? Well, we know earnest money is a credit to the buyer. So I'm going to put that in 5,000. The ad valorem tax credit for 2734 is going to be a credit to the buyer. Okay. So if I add both of those together, 7734, I see I'm going to have as a credit to the buyer. Okay. Now what I want to figure out is what's going to be the debit to the buyer. Okay. And so if I take the difference between the debits and the credits, that's how much they'll have to bring. All right. So the sales price, 80% loan value, 56,000. Discount points, 3 points or 3% of the loan amount. That's 280,000 times 80%. Again, loan value equals 224, and then 3 points is 3%. So that's 6720. Okay. So now if I get a total debit of 56 plus 6720, I get 62,720 is going to be my debit to the buyer. Okay. And if I take the difference, what has to be brought to the act of sale is the difference between the two. And that's 54,986. And so that's what the buyer would have to bring to the act of sale. Okay. So, there's a lot of numbers in here that really don't pertain to credits and debits. You just got to have a good understanding in theory under 1 and 2, as we talked about, what credits and debits are going to be of the actual problem itself, and then just unpack the numbers individually. Okay. Again, we're talking about the buyer. So commission doesn't worry about anything. Interest rate doesn't really mean nothing. All we're looking for is earnest money. And we see there's a tax credit paid by the seller. So that totals a credit of 7734. And then just the debits, right? The debit is the sales price, 280 times 20%. That's the financing 80%. They're going to bring 20% down. So they got to put 56 down. And then you got to figure out the amount of points that the buyer is going to be paying for. Okay. Again, if it's 80% of the loan value times 3%, 6720. If I add those together, take the difference, then they got to come to an active sale for 54,986. Okay. Real big problem. So you want a good methodology, a good method on how to work these out. The big thing is you need to understand steps 1 and 2, right? What is a credit to the buyer and what are debits to the buyer? You're going to add them up and take the difference. Okay. And that's what, in this question, that's what they're going to have to bring. Okay. Down payment is 20%. That's correct. Okay. 20%. All right. A broker associate is ordering business cards. May she put broker on the card instead of broker associate? A broker associate is ordering business cards. Can she put broker on the card instead of broker associate? What do y'all think? Right? So this is just straight out of the Florida law, right? A broker associate has business card. They can't advertise being a broker. They're not a broker. Even though they're licensed as a broker, their actual active, as a licensee, they're a broker associate. In other words, they're under a sponsoring broker. So they have to put broker associate on the card. Okay. That's going to be answer B. Okay. So this falls under advertising and personal information. So a broker cannot use the word broker associate, can't use the word broker. A sales associate or broker associate, in accordance to the law, must use their legal last name. Okay. So if they register with DBPR as Jonathan Jones, they got to use the legal last name as it's registered, but they can shorten the first name and use John. Okay. But they must use the legal last name. What FREC wants the consumer to know is whoever's advertising, are they a licensee or are they a broker? Okay. So their primary job is to protect the public. Okay. So they want to make sure that the public understands who they're dealing with. either a sales associate, broker associate, or a broker. Again, the name of the broker has got to be with DBPR. All advertising, make sure you get it approved by your broker. That is a broker piece, okay? It's a broker advertising, anything that you do, okay? So make sure you get it approved. And you can't advertise as a sales associate, broker associate in your own name, okay? It's considered a broker activity, all right?
Ready to pass the Florida Sales Associate, Broker, Mutual Recognition, or Endorsement State exam on your first try? Get our exam prep database that contains practice exams tied to over 1,000 exam-style questions with detailed explanations. Enjoy 3 months of 24/7 access from any device, including desktop, laptop, tablet, and mobile. Click here and use the coupon code YouTube to get a special discount.
All right, a developer purchased 5 lots measuring 110 by 150. The lots cost $325 per front foot. The developer subdivided the lots into 8 lots and then sold them for $28,000 each. How much profit did the seller make or the developer make, and round it up or round it? Okay, looking for a percent. Okay, all right. So let's go ahead and look at this. Now again, don't look at the answer real quick, but pay attention up here at the screen for a second. You got to unpack these one line at a time, okay? And this is where you're going to have your scratch paper. Now, they're referencing not a length times width for an area. They're measuring a front foot, okay? But they give you a length times width. See how easy that is to fall into. So the measurement they're giving you is not a geometric figure of length times width. They're giving you the cost is $325 per only front foot, okay? So don't get caught in. This is why you got to really slow down and read this problem, okay? Because otherwise you're going to fall into the trap again and go 110 by 150, boom, 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 and you're going to come up with the wrong answer. So the front foot is the length of the rectangle, which is 110 feet, period. You got, let's see, 5 lots that measure 110 feet. So if I take 110 feet times 5 lots, I get a total of 550 total front feet. At $325 per front foot, the investment's going to cost me $178,750 when I purchase it. Okay. I'm going to sell each lot for $28,000. Okay. I'm going to make 8 lots out of this. So my total investment sold is $224. Well, what's my profit from $224 to $178 divided by what my initial investment is? And it says I made 25% or 0.2531. Okay. And I'm going to round it 25%. Okay. So be careful. It's not a difficult problem once you get to the calculation of figuring out the percent profit. What is tricky about this is getting the dimension and the price of the property, because they put an area in there and you have a tendency to multiply that out times 5. Okay. Which is the wrong way to do it. So you got to take per front foot. Okay. Another good example of slowing down, and it's not so much cut and dry as being an area of a rectangle. Okay. All right. So the commission is obligated to report any criminal violation of 475 Florida statute out of chapter 475 Florida statute when knowledgeable of such violations to who? What do we say here? Talking about the real estate commission is obligated to report any criminal violation out of 475. Remember, we talked about a 3rd-degree felony. That's criminal prosecution, right? So who would they report that to? Okay. Now you're talking about the Florida Real Estate Commission. They're the ones that usually hear the cases, right? So if they got a case that's criminal, not misdemeanor, criminal, who do they report it to? What do you think it is? So here's a good review. If y'all want to take a picture of this, this is the time to do it, because these are the civil and criminal penalties. Now, we're going to circle into the answer to the question is the FREC will report all criminal activity to the state attorney general having jurisdiction. Okay. So it goes to the state attorney general. That's the answer to the question. But that's FREC's job to report any criminal activity. So it goes a step further, right? And you remember the term quasi-judicial? Watch this, quasi-judicial. What does that mean? That means they can enforce rules and regulations. They can enforce 475 Florida statute law, but up to a suspension and revocation. Remember, the Florida Real Estate Commission can't put anybody in prison. Okay, they can only fine them, and they can only suspend, revoke, and other penalties. But who can put and imprison people is the authority under a real legal system, right? And the state attorney general has that jurisdiction, okay? And hence the word criminal. All right, so under A1, the FREC must report it to the attorney general, state attorney general of that jurisdiction. Now, second degree misdemeanor, first degree misdemeanor, and third degree felony. You want to know these for the state exam under civil and criminal penalties. Again, if you look out to the right, I got in parentheses area code. So for second degree, it's 256, okay? Which is always a number. The first one is the degree misdemeanor. So second degree misdemeanor, $500 in 60 days, okay? Remember, it's up to either one or both, okay? But I like to go second degree, $500, 60 days. And that's for false advertising. First degree misdemeanor is 111, okay? Again, first degree and up to 1,000 in 1 year, okay? Failing to provide rental accurate and current rental information. That's the example you'll see on the state exam for a first degree misdemeanor. And in third degree felony, we talked about it, 355. Okay, third degree, 5,000, 5 years. And again, the one we saw in the question was unlicensed activity, but it can be incriminating to someone, theft or reproduction of a DBPR licensing exam or providing false information. Okay. So in this case, we're talking about the state attorney general. That's the next level they have to go to for criminal penalties. Civil penalties, denial and recovery of compensation or commission, can again sue court, imposed by lawsuits. Licensee report to the commission within 30 days of either being convicted of a misdemeanor or felony. Remember, that was a test question. How long do you have as a licensee to report any activity of misdemeanor crime or felony? Okay. And it's 30 days. That has to be reported. All right. An investor owns 5 units, apartment buildings. Over a period of time, the investor has found that the expenses to operate the building has averaged 55% of the gross income. If one apartment rents for $920 per month, another for $940 per month, and the remaining 3 apartments rent $900 per month each, all they're asking for, what is the annual gross and net income for the investment? Okay. So they want to know, and when they talk about annual income, they're talking about potential gross income, and then net income is net operating income. Okay. Now, in theory, we're talking about income approach is used by an evaluator to evaluate property or appraise property for an investor of more than 4 units. Okay. 4 more unit or more than 4 units. And you got to make sure you convert all numbers to annual figures. So if you got monthly numbers, you got to multiply them by 12. And here's the acronym I like to use to compute these long problems. And this acronym works. I'm telling you, it works. Please visit every other night, dress casually. That's an acronym I use to unpack this problem. As easy as this is, you'll see how easy it is. Okay. So please visit every other night, dress casually is the long version to this income approach problem. All right, so I got the problem written down. All right, here's my acronym. Please visit every other night, dress casually. Okay, so step 1, and the way I'm going to write this out and unpack this is 5 steps. Please, the first P is about potential gross income. Well, what is about potential gross income? Well, let's unpack this. I got 5 units. Over a period of time, the investors found that the expenses, one apartment rents for $920, so there's 1. Another rents for $940. There's another one. And then I got 3 that rent for $900 per month. So there's my 5. So you can see potentially I can make $45.60 per month times 12. My potential gross income or annual income is $54,720. Well, that's one answer I got in B already. Okay. So I see that my potential gross income. Now, visit, I want to know what my vacancy is and my credit losses. They don't give me one in the problem, so it's 0. Well, I'm going to subtract my vacancy and credit loss from my potential. So 54,720 minus 0 gives me 54,720. That's my effective gross income, okay, which is the every, and please visit every. And then other is my operating expenses. Now, they tell me my operating expenses are 55% of my gross. So I'm just going to multiply 0.55 times my gross. My expenses equal 30,096. So I'm down to please visit every other. I've calculated all that. Now, to get my net operating income, I'm going to take my effective gross income and subtract from it my operating expenses. So my NOI is 54,720 minus my operating expenses, which is 24,624. Okay. And so my gross is 54,720 and my net is 24,624. So watch, in any of these problems you get on the state exam, when it comes to working out longhand, I call this longhand, because a lot of times they'll just give you the NOI and they'll give you a capitalization rate to figure out a value. Okay. But this is one question they're asking you for some specific numbers like gross income and net income. If you follow this model, this memory aid, please visit every other night dressed casually, where you got potential gross income minus your vacancy gives you effective. That's every. Minus your operating expenses gives you your net operating income. Okay. Please visit every other night. The dress casually is a little bit further, and you won't see that on this exam. That's on the broker exam. It's called debt service, and that's going to be your before tax or your cash throw off. Okay. Debt service D, dress casually is your cash throw off. So that's on the broker exam. You won't see that. Okay. So it's please visit every other night is really what you want to concentrate on to get to your NOI. Okay. So your potential gross and your NOI. When purchasing a commercial property from a seller without services of a real estate professional, a buyer would be well advised to carefully verify information conveyed regarding the property. This is sometimes referred to as what? Now watch this now. Purchasing commercial property from a seller without services. What are they talking about? Dealing with a real estate professional. A buyer would be well advised to carry verifiable or verified information about the property. Okay. What is this called? Anytime you don't use a real estate agent or a broker associate or a sales associate and their professional advice or consultation, anytime you don't use that, you're out there on your own as a buyer and or if you're selling property as a seller. Now, this term caveat emptor means buyer beware. That's an old term used in the 19th century when real estate did not have any code of ethics or there wasn't any licensing law. Okay, licensing law didn't come until the early 1900s. Code of ethics, same thing. So back in the 1800s, pre-Civil War, post-Civil War, a lot of people lost their lives over real estate transactions, literally were killed. Railroads were making moves through people's land, and there was just a lot of violence going on. And so one of the terms that came up that has stuck ever since is called caveat emptor, or buyer beware. In other words, if you're not using someone who's knowledgeable with professional expertise knowledge in the area, you're going to have to be very careful and verify information. Okay. All right. That's caveat emptor. Remember, expert market knowledge in this area of Chapter 1. Licensees are required to know about property transfer, market conditions. Remember, caveat emptor means buyer beware. Okay, operating with a real estate professional. And then also understand in the real estate business, there's real estate brokerage and then business brokerages. Okay, so you can actually deal with people relocating in from out of state, say, like in the example, an engineer, or someone in town that comes to you and say, hey, look, I want to open a satellite location for my hardware store. I want to purchase this building for a business. So you can see the knowledge that's needed and how different it can be, okay? And this is the example of what we say when real estate agents possess expert knowledge. If it's not used by the consumer we're talking about caveat emptor. Okay. Again, we talked about, the importance of buyers and or sellers dealing with real estate, the importance of securing an agent that possesses expert knowledge. If not, the term caveat emptor, buyer beware. So typically the non-operation of real estate services, they're out there on their own. And some of them have learned, through the hard school and knocks, the investors. But other investors I know will use a real estate agent just for that reason. All right, let's talk about market value. Market value is what? Well, how is that defined in our studies? Market value. How is market value defined? Looking for a definition of market value. Okay, so let's take a look at this. Let's go back and circle back to the valuation section when we talk about valuation appraisals, etc. And so we need to look at some concepts and types of value. So when we talk about market cost, we're talking about this is an expenditure. Okay, so this can be for the improvement itself, which is the land in the building. So we'll just talk about a residential, either a single family residential or condominium. Includes the actual cost and the land itself with the building. Now, this cost, market cost, is typically the purchase and or any type of contribution that can be made into it, closing costs, etc. Okay, market price is the actual price paid for the property. Okay, this is normally contract price. Okay, this is what market price is. Now, market value is what the property in value should bring in a competitive marketplace. Okay. And it's determined through motivated buyers, being well informed, listed within a reasonable time. Remember, time decay is a real bad feature when it comes to valuation. The longer the home's been on the market, people start to wonder what's going on, and they're not going to pay the value that it's listed for. Okay, and it's got to be financed or paid cash for. Market price. Watch this. Market price and market value should be the same. But let's say, for example, I've got 4 comps. And I'm looking at 4 comps. And the house that I'm looking to list, I'm comparing these 4 comps to. 3 of the comps all come in at a relatively competitive price. Okay, we'll call it that. The 4th comp that I'm looking at, same floor plan as these other 3, and the same matches the same conformity, matches the same floor plan. The 4th one though sold for $20,000 less. And so you kind of wonder, what's the outlier here? Why do we have a statistic of homes selling here, and I got one outlier, same home, nothing wrong? So when it comes to market price, what it actually sold for, when you get outliers like this, it could have been a foreclosure. It could have been a donation, right? Parents could have started their children off in a marriage and sold them an investment property they had for well under market value. Even though market price is what's actually paid for the home and should match market value, sometimes you'll get outliers, okay, where market price is well below market value. So appraisers won't use that. So the concept of market value versus market price, they should match, but you can have some outliers created through different types of situations, okay? So market value is the most probable price that it should bring. Okay, so that's the value that it should bring based on the comps. Okay. All right. A broker followed the instructions of an EDO disbursement or an escrow disbursement order. The seller is going to sue the broker over this EDO decision. Which expense associated with the EDO cannot be reimbursed from the recovery fund. Okay. So this is a big question here. There's a lot of moving parts. We're going to look at it. So a broker followed the instructions of an escrow disbursement order. You say, well, what's an EDO? What's an escrow disbursement order? Remember, that's one of the 4 methods on a dispute that the actual broker can use to disperse deposit money or escrow money. Okay. An EDO is they're going to send it off to the Florida Real Estate Commission and let them make the decision. Okay. Well, if they make the decision and the broker gets sued and has to pay from the recovery fund, okay, They want to know what, from an EDO procedure, what expense cannot be reimbursed from the recovery fund. So what do you think it is? Attorney fees, compensatory damages is the actual transaction damage. Okay, broker's attorney fees. Punitive damages is the one that's not going to be able to be collected. Okay, and that's, punitive damage is more personal injury, like I'm going to a therapist because of this. I got to pay for all this emotional, and for me, all right, has nothing to do with the EDO, has nothing to do with the transaction. So that's not allowed to be secured from the recovery fund. So let's look at this concept, because there's a little bit more to this question than meets the eye. Okay, let's talk about the real estate recovery fund. All right, so what is it used for? It reimburses the consumer who's been financially injured by a licensee, right?
For more practice questions, videos, and insight into the state exam, we encourage you to join our free exam prep webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Click here to get registered.
And so the recovery fund is the last resort to the individual who have been found by the Florida courts to have suffered monetary damage from an act committed by a real estate licensee. Okay. Now, the reimburse the broker who pays money damages as a result of the EDO, the broker must notify FREC. The broker must defend it diligently. We're talking about the recovery fund. So first, the broker's got to notify FREC and then defend it as best they can with themselves and pay for as much as they can of the punitive of the damages itself. Then the broker is not suspended in an EDO recovery. Okay, remember, an EDO recovery is where the real estate commission made the decision on how the money is going to be dispersed. It's not the broker's decision, it's the real estate recovery. Now look at the blue box below, legal effect. That's a term you want to know, where FREC is exempt from civil liability while performing commission duties. So the Florida Real Estate Commission cannot be sued by the public. Well, if they made a decision on how a disbursement is going to be made, right? How a disbursement is going to be made, and a lawsuit comes about of that, they can't be sued. So the only person they can sue is the broker that dispersed it. Well, since the broker didn't make the decision but is getting sued, the Real Estate Commission says you can pull from the recovery fund. Okay, everything but punitive damages. Okay, and you won't be suspended, because remember, part of a recovery fund taking money out of it is the licensee is suspended until it's paid back. Okay, no punitive damages. It's a real easy concept. Look at the big picture. Legal effect in Florida says you can't sue the real estate commission. The public can't. Well, if they make a decision on how a escrow needs to be dispersed that was submitted by the broker, which they can, that's part of one of the methods, and a lawsuit comes about it, well, FREC can't get sued, so the broker's going to. Well, it's not the broker's decision. So what FREC says, or the law says, is they can pull from the recovery fund whatever value they're being sued, less punitive damages. Okay? You want to know that word legal effect at the bottom left. That substantiates the whole principle of a broker being able to recover from the recovery fund on an EDO lawsuit. Okay? Because you can't sue. If you could sue FREC, then that legal battle would be between the commission and the public, but you can't. Okay? All right. FHA requires the borrowers to pay what? FHA. You got to ask yourself, what is FHA? Okay, the Federal Housing Administration, or excuse me, Fair Housing Administration. We're talking about a loan process that the government doesn't lend money, but they insure money. Okay, so what does FHA require borrowers to pay? Now remember, watch this. FHA and VA are two different loans, okay? VA does require upfront fees or front-loaded fees, okay? FHA requires the down payment of 3.5%. The VA doesn't require a down payment, but they do require front-loaded fees, okay? So FHA, the only thing that they really do require is 1/12 of the estimated taxes are paid each month, okay? There is no user fees, no discount points, and a funding fee belongs to the VA. It's called the VA funding fee, okay? All right, so 1/12 of the estimated property tax. So here's the characteristics. Let's look at FHA loans real quick. Remember, because it's insured under A, the actual borrower is going to pay a mortgage insurance premium or an MIP, not a PMI, which is private mortgage insurance. That's a conventional loan. MIP or mortgage insurance premium is what's paid on an FHA loan. Remember, the loan is insured. It can be any mortgage banker, any commercial bank, savings association, Chase, Capital One, any bank can make FHA loans if they're qualified to make them, okay? Discount points, we all know what discount points are. Amount down payment, 3.5%. Insurance, FHA requires property to be escrowed for hazard and property tax. That's what we're talking about. And then under the mortgage and insurance, under number 6, the principal, interest, tax, and insurance plus the MIP is actually the monthly payment. So they do require property tax and insurance to be paid monthly, okay? The appraiser has to be a qualified appraiser, okay? A qualified FHA appraiser, okay? All right. Which statement is true regarding owner-developers? Owner-developers in Florida, which statement is true? Regarding owner-developers. Remember, an owner-developer, as a licensee, you can work for an owner-developer, okay? You can work for an owner-developer, unlicensed, owner-developer unlicensed, but has to register with DBPR. But you can't work for an owner-developer and not a broker, right? So let's look at what statement is true, okay? All right, so categories of real estate licenses. When we come back and we talk about owner-developer, here's what we're looking at. What is a broker? Okay, so they sponsor and compensated for real estate services. An owner-developer is someone who is a registered with DBPR and non-licensee. Now, they can have a staff of non-licensees, but they have to be paid salary. Or they can have a staff of commissioned licensees, okay, which are sales associate and broker associates, okay? As a sales associate and a broker associate, you can only work for one broker and or for one owner-developer. So you can't work for a broker during the week and an owner-developer on the weekend. So your license is put under either one, okay? So you can only work for either one. But an owner-developer can have a sales staff that comprises of non-licensees and licensees. I actually know of a developer in Destin and has a staff. They're all paid salary. There is no licensees that work in it. He does condominiums, but you know, everybody that works for him is unlicensed, but they're paid a salary. Okay. So to go back and answer the question again, the statement that's true regarding owner-developer is answer D. The owner-developer's sales staff must hold a real estate license to be paid a commission. Okay. To be paid a commission, you got to be licensed working for an owner-developer. All right. To compute the dollar value of a loan discount, each discount point is equal to what? The dollar value of a loan discount. Remember discount points. Each discount point is equal to what? We're not looking for the increase in yield. Okay. We're just looking for a straight question that says, what is each point worth when we're calculating discount points? That's all they want to know. Okay. There is no computation of increasing yield per discount point. They just want to know what the dollar value of of a loan discount. Each point's worth what? That's all they want to know. Okay. All right. So here it is. Let's talk about discount points. This comes under the finance section. Remember, this is prepaid interest. Okay. So 1 point equals 1% of the loan amount. That's what they want to know. That's what a discount point is. The dollar value is 1 point of the loan amount, or 1% of the loan amount. It's prepaid interest, and it is a debit to the buyer on the closing disclosure. For example, if a lender charges 3 points on a $300,000 loan, how much will the buyer pay in discount points? How much will we put in that financial charge on the CD? So it's 300,000 times 3 point is equal to 3% or 0.03. So it's a $9,000 debit to the buyer, annotated again as a debit, not a credit, a debit to the buyer on the closing disclosure form, just like we saw in that math problem. Okay. So when you're looking at the dollar value of a loan discount, 1 discount point, 1 point is equal to 1% of the loan amount. Okay.
Ready to pass the Florida Sales Associate, broker, mutual recognition, or endorsement state exam on your first try? Get our exam prep database that contains practice exams tied to over 1,000 exam-style questions with detailed explanations. Enjoy 3 months of 24/7 access from any device, including desktop, laptop, tablet, and mobile. Click here and use the coupon code YouTube to get a special discount.
All right. Which condominium document is required to be given to prospective buyers only for new residential constructions of more than 20 units? Okay. What are we looking for? So you've got an owner, developer, or developer that has more than 20 units. What document must be given when it comes to new residential construction of more than 20 units? Condominium, more than 20 units. Complex, more than 20 units. Buy a new one from an owner developer. What document must you be able to review when it comes to new development? Okay. So we're talking about a prospectus. Okay. Now, I've got a page here I developed that's going to cover a little bit of material that may make sense to you, may paint a bigger picture. So if we start on the left, when purchasing a new condo from a developer, remember, over 20 units, the developer's got to prepare a prospectus. So you may ask, what is a prospectus? That's a term we see in an answer, but we want to know what it is. So I did some research and actually went to a condo development and pulled out the table of contents only. Remember, this is a document that is very thick. It's got a lot of information in it. But a prospectus, by definition, is a summary of all the major points contained in the condominium and in the documents itself. So it's a compilation of information for the owner to review. Remember, this is a new development, a new purchase. So it can be as much as a description of the condominium, general information on the forms of ownership, restrictions on the use and occupancy. If you look at the table of contents, who the condo association is, utilities, other services, management of the condominium, share of the common elements, estimated condo budget. Okay. Not any one in singular is going to be given for a review for the buyer, but a prospectus is a collection of all this information or all these major points that are going to be in the document. That's called a prospectus. Okay. You don't have to identify the points in the prospectus, just know a prospectus. More than 20 units got to be given for review of the buyer. Okay. Now, if you look at the top right, disclosure requirements, new condo sold by a developer, more than 20 units, they've got 15 calendar days to review it. Okay. And again, prospectus and they didn't have the other answer, and an estimated operating budget are the two documents that are required. Okay. This answer only called for prospectus. They didn't have operating budget. On a resale condo, this is outside of the new development, so it's a resale. Someone's owned it. Maybe 2 or 3 people have owned it in time, since it's a resale. 3 business days, right, to cancel the contract after review of what? Those are the required for a resale. Declaration, articles of inc or incorporation, the decks, they call it the decks in the articles of incorporation. Bylaws, which are rules and regulations, and frequently asked questions and answer sheet. Okay. This kind of wraps up everything when it comes to condominium. Okay. New development, more than 20 units, prospectus. And if you see another answer, operating budget, that's going to be both of them. Okay. 15 calendar days. Resale is 3 business days to review after receiving. Got to receive them. It's not necessarily when you sign the contract. right? It's when you receive the documents, all right? Makes a big difference. Could sign the documents or contract today and not get the documents till next week. Well, 3 days has passed. I haven't received them yet. So it's whichever comes first. You can get them on the day of signing. So it's when you receive the documents, okay? And in 3 business days for a resale. And I got a little picture in here about condominium ownership. Remember, you own fee simple. If you look at the bottom picture, fee simple, that's the highest and best recognized in the land. Fee simple ownership. You get full ownership of the property. But you don't own anything about the building or the swimming pool in the top picture, anything of the common areas. You only own the unit in the sky, okay? Or the cube. I like to call it the cube in the sky. So when an appraiser comes in and appraises a condominium, they don't measure the building, the outside, like they do a single family residential. They measure the inside of a condominium because that's what you own, the inside. Interior walls is what you own. The building is owned by the association. That's common areas. Swimming pool owned by the association. Everything else is owned by the association, of which you contribute condo dues and have free access to. Okay. All right. A seller and a buyer enter into a real estate contract. The seller defaults. The buyer sues the seller to go through with the contract. This action is known as what? So you got a buyer and seller into a contract. The seller defaults. What does it mean by defaulting? They changed their mind, defaulted. There is no condition subsequent, right? So there is no exit clause, no escape clause, they call it, to get their deposit back. They're in default. They're in breach of the contract. So now the buyer can sue to have them go through and execute the contract. What's this called? Specific performance, okay? So let's talk about the remedies of breach here. So it's more of just, I'm changing my mind. Don't want to sell, don't want to buy. Specific performance defined under definition is a sue for performance. So the seller defaults, the buyer can sue to sell the home. The buyer defaults, the seller can sue the buyer to buy the home, okay? Now, this is not liquidated damages, okay? Liquidated damages, liquid money damages. In other words, only thing you surrender, both buyer and seller, is the earnest money or the deposit, okay? So if it's written up as a liquidated damages contract, you can't sue for performance, okay? So you got 2 different types of breaches, specific performance and liquidated damages. And then rescission is nothing more than a cancellation and return deposit, okay? So that's only, that's an escape clause. In other words, property didn't inspect correctly, can't get financing, whatever the condition is that allows them to escape via an amendment or an addendum to the contract, an escape clause, that is a rescission. We're canceling, I get my money back. There is no suit involved. And then compensatory damages, not punitive, but compensatory damages is only suit for transaction purposes, okay? Only transaction damages, which eliminates punitive. So liquidated damages is not performance, but it's money damages. All right, the seller has an existing first mortgage. In order to limit exposure to further liability, the seller should find a buyer ready to what? Seller has an existing first mortgage. In order to limit the exposure of further liability to who? The seller, right? What should the seller do? Read the question. You've got a seller has an existing first mortgage. In other words, it's in place. Now, in order to limit their exposure in the future for liability, when they're looking for a buyer. Remember, this is a twofold question. One is, do I want someone to assume my mortgage, right? Which is in place. If someone assumes my mortgage, what's my liability in the future? I could be liable for that if the new owner or the new buyer defaults on that assumed loan. We're both responsible. Remember, the buyer's responsible and the seller can be. But the only way is to get a new obligation put in there or finance with new financing. Once new financing comes in, then my loan and mortgage is eliminated. So that takes the liability away from me. So we're looking at answer A, okay? And so let's look at assumption versus subject to. I got some pretty little cartoon characters here. So the answer is obtaining new finance. So let's look at both of these. These are important that you understand. Who is responsible for default or in a default of payment? Okay. So let's look at the top one right there, assumption. This is both buyer and seller is liable for the loan. So if you look at the house, little cartoon figures, they're handshaking, right? One's got a briefcase. So they're handshaking over an assumed loan. But the buyer who's got the briefcase, if they default on that loan, then the mortgage company is going to come after the seller. Okay, so they're both responsible. So that doesn't limit the liability on an assumed loan. Okay, subject to, you've got an investor. The young lady standing on the green grass is an investor. The young man standing next to the bank owns that home, but is fallen short and can't make payments. So what the owner of the home does, the young man, is deed the property to the investor. Now the investor has control of the property. So the owner of the home still has the loan. Okay, so the loan or the transfer, the loan is subject to the transfer of the property. The investor owns, or the buyer, let's call it the buyer investor, owns the home, going to make payments on it, but the seller still owns the loan. So if the seller defaults or the buyer defaults and doesn't make the payment on behalf of the seller, the bank's going to go after the seller. Okay. And so to keep the things in perspective between assumption and subject to, assumptions, both are responsible. Subject to, always remember the seller's going to own the loan still, but the buyer is going to be deeded and owns the home. We'll make payments for the seller, but if the buyer defaults, the seller is going to be responsible. Okay. Now, circling back, we're talking about an assumption. Okay. In order for this assumption to be not a liability for future for the seller, he's going to want, or she's going to want, a brand new loan put in there. That will eliminate the liability. Okay. So we're talking about obtaining new financing. All right. Which government agency do developers of subdivisions with 100 or more lots have to register? Okay. Straight out of your book. Okay. So you've got a government agency, and we're talking about interstate commerce or dealing over state lines. A developer of a subdivision with 100 or more lots, who do they have to register with? We're talking about a developer that has 100 lots in Florida and dealing with over state line sales. Okay. So here's how this works. This is under the ISLA Act, or the Interstate Land Sales Full Disclosure. So this was passed by Congress in 1968. Okay. And it regulates interstate land or sales across state lines, protects consumers from fraud and abuse in land sales or leasing of land. So here's the rule. 100 or more lots, you got to register with CFPB, the Consumer Financial Protection Bureau. Okay. Now, you got to provide the buyer disclosure property report, okay, under the ISLA. And if you give them a report, then the buyer can cancel even up to 7 days following signatures. Okay. And then without a report, this can go up to 2 years cancellation following signatures. Okay. If you got 25 lots or less, the developer, they're exempt from this law. So it's anything over 100 lots, you got to register it with the federal government, and that's going to be under the CFPB. So that's the government agency that will monitor that. Okay. It's under the ISLA, Interstate Land Sales Full Disclosure Act. Okay. Which condominium document must be given to the buyers of residential units sold by developer, more than 20 new residential units, and by a seller of a resale unit? Okay. Again, we're talking about frequently asked questions and answer sheets. Okay. For disclosure required by developers and buyers on purchasing resale: declarations, article of incorporation, bylaws, frequently asked question and answer sheet. On a resale condominium, remember the buyer's got 3 business days to cancel after receipt of the buyer by the buyer of the condominium docs. Okay. So we're talking about frequently asked questions and answer sheets. Okay. All right, we're getting into the legal description here. This is kind of a real estate calculation, so pay attention to this. You're going to have to need a scratch paper out. What section is located due west of section 6? What section is located due west of section 6? Okay. Section 6. What section number is located due west of section 6? So you're going to have to draw this out, right? And you remember from your studies in the legal descriptions, a township contains 36 sections, okay? And so each section is numbered, start at the top right, 1 through 6, 7, 13, and so on, all the way to 36 in the bottom right corner. So you got to find where section 6 is, and then just look what's due west of it. And, your answer should be here. If you draw that out on a piece of paper, it's going to look like this. Watch this now. This is very important because if you draw a township or a township under B, this is township B, and you got 6 sections that go across. They're asking you what's west of section 6. Well, I don't have anything west of me. I got 5 that's east of me. I've got 7 that's south of me. But what's west of me, I don't have anything unless I have another township, right? And if I got another township next to me, it's going to start in section 1. You see? Does everybody see this on how this works? All right. So they're asking you what compass direction west of section 6, what is that section called? And that would be another section called section 1. Okay. Because the way they're numbered, 1 through 6, and you drop down 7 through 12, drop down 13 through 18, all the way to 36 in the bottom right. That's one section. Well, they're asking you, hey, what's west of section 6? And you're going, well, if I draw that out, I don't have anything. I got to put another section next to it. That starts with 1, 2, 3, 4. So west of 6 is going to be another section in a different township, and it's going to be section 1. Okay? Now, everybody remembers the government rectangular system, principal meridian, baseline. Those are the intersecting points of the origin where you start your measurement from. Your range lines, they do run north and south, but they're separated east and west. And then your tier lines do run east and west, but they're separated north and south. They intersect a 6x6 or a 36 square mile area called a township. Okay. And then one section is going to be a 1x1 square mile. And there's 36 of those in a township. Each section has 640 acres. And then 1 acre is equal to 43,560 square feet. Okay. So that's a little bit of theory about the government survey system or the government rectangular system. But if you get a question that asks you, again, what section is located due west of 6? You're going to draw your box, your section box out, number them. Just number them all the way down. Doesn't have to be perfect. Just number them. And then you're going to see 6 is in the top left corner. And they want to know what's west of that. Well, I got to draw another section. Then I got to start with 1, 2, 3. So section 1, if they're contiguous, touching each other, it starts out with section 1. That's what's west of 6. Okay. All right. An item that is credited to the seller is the what? An item that is credited to the seller. What is that called? Right. And again, this falls under the principle of debits and credits, right? On the closing disclosure form, who's going to get credits, who's going to get debited. And so we're talking about a seller and a credit to the seller. Okay. All right. So let's look at this. Again, looking at the rule of thumb for closing costs or credits and debits. And we're talking about a credit to the seller, obviously the selling price, anything prepaid on taxes. And that's the answer. Answer B, seller's prepaid items. Remember, when the item is prorated and the seller pays it in advance, they're going to get a credit. Okay. If it's paid in arrears or at the end of the year and it's by the buyer's in the home, the buyer would get a credit. So anything that's prepaid, watch that now. It's just not necessarily taxes that are prorated, prepaid taxes. Okay. And then debits to the seller is payoff, interest on the loan, prorated taxes in arrears. Again, that would be a debit. Assumed loan interest, prepaid rent, tenant security deposit, docked stamp taxes, commission can be a debit to the seller, prep of the deed, attorney fees. And then we saw credit to a buyer and a debit to the buyer in the problem we worked before. Okay. So you want to know kind of the rule of thumb basic rule of thumb from your text, what does a credit to a seller is, what a debit to the seller is. Credit to the buyer, debit side. This is all comprised on the closing disclosure form. And that's what determines how much the buyer will bring, right? Debit minus the credit, how much they got to bring to closing, and how much actually the seller will get and walk away with, okay? All right, a broker promises to give $20,000 bonus to the first sales associate who sells 20 homes. What kind of contract is this? A broker promises to give $20,000 to the first sales associate who sells 20 homes. What type of contract is this? Right, let's look at this now. Right? So what you have to do in the answers, if you look at them, is a unilateral contract, executed, implied, and bilateral. Okay? So let's look at executed and implied, because those two kind of are related, and unilateral and bilateral are kind of related. So executed means it's completed, right? So we don't have a completed contract here. We just got a promise. Implied means action. Well, there is no action here. This is a promise. So this promise is expressed either in writing or orally, right? It's not through action. Action would mean action, right? If you're at an open house and you're talking to a buyer and all of a sudden they want to write an offer and you start writing it, you don't even express anything about an agency agreement. You just start writing the offer. Through your action, they're going to assume you're representing them, okay? So when a broker promises, that's not action. That's not implied, because that means action, okay? The promise is either declared orally, verbally, or in writing to the agents. So executed and implied would not fit this theory or definition. So we have to understand, is this unilateral or is it bilateral? So who's making the promise here? Well, it's the broker. The broker has to fulfill this promise only if a salesman or whoever the first salesman is to sell 20 homes. Do the salesman have to sell 20 homes? The answer is no. Does the broker have to promise to pay $20,000 if one does? The answer is yes. So the obligation and the commitment comes one way. It's the broker to the agents, and that's one way, unilateral, okay? All right, so we look under classifications of contracts. Again, formal, informal. Contracts that are formal are usually in writing. There doesn't need to be a raised seal, on a contract to make it valid. Everybody understands the essential elements that make a valid contract. Informal contract is going to be a verbal or an oral agreement. So know that that's called a parole. And then we look at bilateral and unilateral. So bilateral is two parties agree, obligate, purchase agreement. Buyer brings the money, seller brings a clear title. There's obligations from both sides. And then unilateral is only one party is obligated in exchange for something. So in this case, the broker's promising $20,000, must pay $20,000. The first salesman that brings 20 homes for sale, okay? But the salesmen don't have to make the sales if they don't want, okay? But the broker has to pay it if it's executed, okay? So it's unilateral. And then remember, implied is through action only. So this was a promise. So this was expressed through either in writing or verbally. You got to assume it was one or the other in the problem when he said he made a promise. Again, these little verbiages, they didn't come out and said the broker wrote out or made in writing, or the broker sat in the meeting and verbally told him. He just says there was a promise made. So you have to understand that promise could be expressed or in writing. So we know it's not implied, is what the principle of looking at these questions and how they relate, okay, to eliminate the process of elimination. All right. A first mortgage holder can agree to take a lower lien priority using which instrument, okay? Now, we're talking about lien priorities and how they're registered in the land records, okay? Lien priorities and how they're registered in land records, okay? So a first lien holder, this is a first lien holder, can take a lower priority. In other words, they can switch with a second lien holder. What is this called? What's it called when they switch or agree to switch? Okay. What do they call it when it's an agreed upon to switch positions? First lien holder or first mortgage holder can agree to take a lower lien position using which instrument? In other words, an agreement to swap with the second lien holder. So we're talking about a subordination agreement. Remember, lien priority is the satisfaction of the payoff, of the debt payoff when the property is transferred. Okay. Now, the superior position, that's where tax liens and special assessments always go to number one. They have priority over everybody. Any type of lien that's filed is usually in the finance area of a mortgage, is financed the date it's recorded. So a first mortgage lien will be first. And if they refinance and get a second mortgage or a HELOC, then they're recorded as the date they're recorded. So they'll fall in line behind or under the first mortgage. Okay. Construction liens, remember, not the date they're recorded, but when the job started. Okay, so that can go up to a second or third position. But a subordination agreement is the swapping positions between first and second lien holders. We see this in a wraparound mortgage. We talked about wraparound mortgage where the second wraps around the first. Okay, not really a complicated method, but it is an investment method where there's seller financing involved, where the actual seller of the home has a remaining mortgage with a bank in a first position lien and will sell the property and finance it, right? And put a second mortgage out and finance a note and take back a note from a new buyer at a higher interest rate and obviously more money. So that second loan of this investor that takes will wrap around the first that they're paying, okay? And so what they're going to do is collect money from the sale and then continue to pay the first mortgage. In that agreement, and of course the bank has to agree, in that agreement, they can swap positions, okay? And that's called the subordination agreement. So they can agree to swap priority and lien positions. And that's important, obviously, if a house forecloses. You want to make sure you're high priority so you get paid, okay? So subordination agreement is what we're looking at. And so I got a little drawing right here, a first mortgage, a HELOC, refinancing. So the mortgage position is the position and the date recorded. So if you look at the top scale, January 1st is a first mortgage. February 1st could be a HELOC. June 1st could be a refinance or a second mortgage. So they're in lien position 1, 2, and 3. Okay. And then in the bottom position, let's say the homeowner wants to refinance, okay, wants to refinance the home. Remember, the date recorded is going to be the date that it's going to be the position it'll take. So if they refinance on a second mortgage, on the bottom one as $175,000, they're going to pay off the first mortgage. So now everybody just bumps up one. So the HELOC becomes first position, and then the refinance takes second position. Well, there can be an agreement to swap positions, okay, called the subordination agreement, all right? Because mortgage lenders don't want the risk, okay, associated with a second lien. They always want to be in first priority, okay? All right, a buyer signs a contract to purchase a property that is subject to a mandatory homeowners association. The buyer did not receive a disclosure concerning the association before signing the sale and purchase contract. So we're talking about a purchase made based on a mandatory HOA requirement, okay? And so the buyer signs that contract and it is subject to a mandatory HOA. The buyer did not receive the disclosure concerning the association before signing the sale and purchase agreement. So which statement is true? Okay. Which statement is true? Remember, we talked about it's not necessarily when you sign the contract, but it's when you receive it. So keep that in mind, okay? So we're looking for answer B, okay? So remember, the sales contract was signed, didn't receive the actual HOA mandatory. So the cancellation can come 3 days after receiving the disclosure. So It's really based on the homeowner, the actual listing agent, getting the documents to the buyer, because that's when the clock starts, okay, when they receive. If a disclosure is mandatory, dollar amount of the assessment, special assessments, if any restricted covenants, all these dues, association payments, remember, 3 calendar days to cancel after they receive the actual disclosure, okay? So answer B. Not when they sign it, but when they receive it, okay? All right, a buyer is assuming the seller's existing mortgage. Which agreement relieves the seller of liability for the assumed mortgage? Remember, there's a term that we use that alleviates the seller's liability, right? What's that term called? Let's look at this again now. Don't be too quick. The buyer's assuming the seller's mortgage, okay? So that's an assumption, all right? Remember how you define an assignment. An assignment is what? When you assign a contract, is a contract, okay? But when you assume a mortgage, that's a mortgage that's already in place, okay? Which agreement relieves the seller from liability? Remember, on an assumption, we went over both buyer and seller are responsible. If the buyer that assumes a loan defaults on the debt service, the buyer is going to be responsible, but so is the seller, okay? So in this case, the seller's got an assumed loan, but wants to mitigate the liability. The seller does. How do they do that? What do they do? What the seller of liability, an agreement to relieve the seller liability for the assumed mortgage, comes in the form of a term here, right? So we're talking about novation. Remember, novation is substituting an entirely new loan for a current loan, okay? In real estate, if you look at the green box, novation is simply replacing someone or something in a contract with a new someone or something else, okay? All parties must agree to the replacement. Novation replaces the original contract. It could be an original, in this case, it's an assumption, with a new one. Remember, when someone assumes a mortgage, there's both liability, 2 liabilities, okay, buyer and seller. In order to for the seller to become non-liable, they would request a novation or a new obligation in place of the assumed loan. Now that alleviates the seller, okay? Let's see, 1 year residential lease, 6 month, and so this is an example I got in the yellow box. 1 year residential lease, 6 months into the lease, the tenant finds another tenant to assign the remaining 6 months. Okay, that would be an assignment. All right. But for novation, what you would do is get a whole new commitment, a whole new obligation or a commitment for the remaining 6 months. That would alleviate me from a lease. Okay. In a mortgage assumed novation, again, a new loan from a new lender or from a new borrower would alleviate the obligation from the seller. Okay. So we're looking for the term novation. All right, a broker mailed a signed purchase offer to a property owner. Instead of signing the purchase offer agreement or contract, the owner sent the broker a telegram accepting the offer. So which is correct? So again, go back and unpack this. So the broker mailed a signed offer to a property owner. So they got a buyer, then they mailed it in the mail to the property owner. So instead of signing the purchase agreement and accepting it, the owner sent the broker a telegram, whatever the telegram, saying they accepted it. So they didn't send the contract back signed. They just sent a correspondence of acceptance through a telegram. And so they want to know which of the following is correct. All right, so if you look at each one of these, you got to know what the law says in common law, okay? In the common law portion, principles and practices. If you look under B2, okay, and we're talking about in common law, revocable offers can be withdrawn prior to acceptance, okay? So anytime a buyer puts an offer in, they can actually withdraw it prior to the owner of the property accepting it. Now, what you have to do is define what acceptance is. Okay, so acceptance is when there is effective transmission by the offeree. Okay, in this case, the seller. So this constitutes a valid contract. Okay, the fact that transmission was done through telegram constitutes a valid contract. They said, hey, we accept your offer. Doesn't have to be a signed contract back, although the contract will be signed and follow the transmission, but transmission of acceptance made by the telegram, phone call, email, whatever it may be, does constitute a valid contract. Okay. All right. A lender promises to make a loan to an owner of a new apartment. Building a new apartment building once construction of the building is complete. This is called what? A lender promises to make a loan to an owner of a new apartment building once construction is complete. What is this called? So you're talking about a new construction loan, right? Going to make a loan to an owner of a new apartment building once construction is complete. So a lot of times these lenders will come in and they'll do a new construction loan. But on the back end of this construction loan, it has to be converted to a mortgage, okay? Because they can't hold a construction loan for 20 years, okay? So they're going to convert it to a mortgage. So typically a lender on the front end will approve to a contractor a new construction loan. In it with a takeout clause stating they'll convert it to a mortgage on the back end, okay? Or if it's not done by the same company, there is a company that will ensue that and finance it at the end. Again, we're looking at a takeout commitment, okay? So a takeout commitment is written promise, if you look at D, by a lender to provide long-term. Again, long-term financing is a mortgage, which is permanent, okay? What it does is it replaces interim or short-term, okay, or a bridge loan, okay? So this is when the completion of a project, new financing, new construction loan, at the end of it, remember, the builder's only paying interest only on what's being drawn to build the property. But at the end, when the property's done, right, it has to be converted now to a mortgage, okay? They got to replace that interim financing or short term. That's called a takeout commitment. It's nothing more than a letter by a lender to provide long-term financing on that interim financing, okay? And if you ever done any construction building and done a new construction loan, you know that you have to get it financed at the end. Okay, it's got to be a replacement. All right, next question. When a new home is constructed, the structure is inspected to make sure it is built in compliance with the building codes for wind load strength, ventilation, and so forth. If the inspection is successful, what is the building inspector, what will they issue? Okay. Remember, a new home is constructed. The structure is inspected to make sure it's in compliance with codes for the wind load strength, ventilation, so forth. So all the inspections are done. So this is kind of the last inspection that the inspector does. If that's a pass and it's successful, they're going to issue, the building inspector will issue the builder a document. What's that document called? Okay. Now, let's circle back and talk about government controls and what we talk about influence in the market. Remember, the government has control in the actual land and its restriction and usage from zoning, residential, commercial, etc. Okay, that's one area that they have control in. This is the government's role in real estate, and we're talking local level, county or city. The other area that they have control over and makes decisions called building codes. Okay, building codes is when new construction is done, as you can see at the bottom right picture. There has to be areas that have to pass inspection, and it has to meet code. What code is a restriction that the government sets at the local level on how a building must be built, okay? Whatever it may be. Ventilation, again, got to use certain fasteners for hurricanes, in Florida. So it's a requirement and a restriction at a minimum that a builder must follow the guidelines of these building codes put out by the government. After this building is inspected, each phase is inspected before they can progress and go on. For example, they come out, the builder comes out and pours a slab. It may frame the home. Well, after that, he's got to stop, and he has to have the inspector come out, inspect all the work. It's got to meet the building code requirement. After that, they'll issue a pass certificate. They go on to the next phase. They'll put the roof on, and then they'll put the siding on, external siding, and as each phase is completed, it gets inspected. The very last phase, after a completed home, so you're out in front of the home, it's all done. The inspector comes in and will inspect it all to meet the codes. Now it is ready to sell. If it's ready to sell, it's going to be occupied. So it needs a certificate of occupancy. In other words, it's going to pass all the code that is required throughout all the inspections. And at the very end, the inspector will give the builder a certificate of occupancy, which means now they can sell the house and have somebody live in it. Okay. So we're talking about a certificate of occupancy. Okay. So this is what the question said. New construction home, structure was inspected, made sure it was in compliance, again, with the building codes, wind load strength, ventilation, and so forth. If this inspection is successful, okay, the building inspector will issue. Now, a building permit, a couple of D answers, a building permit is what a builder must get to begin the process of building. So they have to get permits, okay? Lis pending means lawsuit pending, so that doesn't even fit it. Notice commencement, I haven't heard that. But this one that fits this principle is certificate of occupancy, okay? All right. The rights of an owner of land that abuts water are referred to as what? Rights of an owner of land that abuts or is contiguous up against water, adjoins water. What is that referred to as? Again, we're talking about water rights. Now, there are other terms that you may see on the state exam, like littoral rights. Those are water rights that are against large bodies of water. Okay. Riparian deal with river, running water type. Accretion is when land is created through the actual silt and elements in the water. River running streams and stuff will actually deposit and form land. Erosion is when water, the hydraulic force of water, takes away land. Alluvion is the deposit of soil resulting from accretion. The accretion is the soil that gets deposited, and alluvion is the land it forms, okay? And then reliction is when water just recedes, okay? It exposes land. So a dry spell in a lake, water will come down, you get land that exposes, okay? Again, reliction is a term where the owner of the bank to that water will own the reliction to itself, okay? Again, that's uncovering additional land by water receding. Okay, so just a few other definitions, but we're talking about land that abuts water is riparian rights. Okay, here's a couple of pictures I got in here that I put. Accretion, you can see the inside of the bank over time, soil is deposited. Erosion, over time, the bank's taken away. Okay, and then alluvion is when soil is deposited. Through accretion, it forms land. And then reliction is when the water drops, you can see the land that it exposes. So, rivers drops, lakes drops, as the water drops, land becomes exposed. Okay. So just a couple of pictures kind of to bring some light to that. All right. Next question. If the Fed decides to sell securities through open market bulk trading, the result will be what? The Federal Reserve is what creates monetary policy, okay? So they can actually close the interest rate, open the interest rate, and that gives monetary policy, allows them to flow money into the community and not flow money into the community. We're also broken down into 12 district banks when it comes to the Federal Reserve, which is a source of money for our banks. In Florida, we're in the Southeast District, which is in Atlanta, okay? District 6 of the Federal Reserve. So banks can borrow money from the Federal Reserve at a discount rate, which is basically a wholesale rate, like 1.5%, and then they'll turn around and lend out the money at 4 and 5%. That term arbitrage is the difference in the spread. Of that yield is where they make money. So the Federal Reserve has a lot of play in the industry when it comes to financing. And one of the questions you'll see from the Federal Reserve is they decide to sell securities through open market, bulk trading. What happens? So if they're selling securities, that means people are buying them. Okay, so what does it do to money? What does it do to money? Does it do anything with the interest rates? But what it does with the money is it decreases the amount of money in circulation. Why? Because now the Federal Reserve has it. They sold these securities. Okay, and so we're talking about a decrease in the money of circulation. Again, here's a nice little picture I put together. This is the Federal Reserve map, the 12 districts we are. We're in District 6, as you can see in the southeast. Atlanta is the headquarters for District 6. This is where banks can borrow money from the Federal Reserve at a low discount rate, called discount rate, and turn around and lend it out. Okay. Now, let's look at the Federal Reserve, the regulatory body itself, and the Federal Reserve. They create monetary policy. So the Fed can influence the availability and the cost of money. In their open market policy, they can sell securities. This is what reduces circulation of money in the system, if you want to sort of speak, in the public. Okay. So if they're selling securities, people are buying them. That means money's coming out of the public into the Federal Reserve, and so there's less money to circulate. So it decreases. Okay, that's part of their open policy. Remember, discount rate. Discounting is where they can borrow money. The banks can borrow money from the loan Federal Reserve, and then of course they set policy as far as banks maintaining a certain level of deposits. Okay, those are restrictions. So we're talking about the Feds. Let me go back to the question. Decides to sell securities. So they sell the security in the open market, bulk trading. This will result in a decrease of money in circulation. Okay, so it's all going to go back to the Federal Reserve. What are special assessments? So it's used to help pay for some public improvements that benefit the property. Okay, falls under the property tax special assessment concept. Okay. Again, used to pay one-time tax levied to help pay one-time tax levied to help pay for public improvements. That's what special assessments are. It's a one-time tax. Okay. Just like a property lien under A2, a special assessment lien will go to number one priority. Here's the paving question I was telling you about. Okay. You may see this on the state exam, or it could be sidewalks or a sewer system, whatever it may be. But if they got a paving question, they're going to actually give you, the numbers, and it's going to be levied or based on a front foot basis of the road they're paving. Okay. And the way you calculate that is you take the front road footage times the cost per foot, like we did that one problem. Now in the problem, they're going to say the government or the county or the city is going to pay so much. Well, you subtract that out of the total cost, and that's what's left for you to pay as part of your special assessment. Don't forget to divide it by 2, because why? You got neighbors on one side of the road and neighbors on the other side of the road that will pay for this total bill. So you have to divide it by 2. And that's what the answer will be. Okay. Because they're asking how much is your commitment. So you always divide by 2. Okay. Does that make sense about that? Right. You live in the condominiums across the street, and on this side of the street, you got other people live. So to pay for this paving, draw a line down the middle of the road. Well, that total cost will be split in 2. You're paying your side and they're paying their side. Okay, so you may see that on the state exam, that type of problem. But that's what special assessments are. Okay, good. One-time tax. You can get special assessments in condo dues. So you got condo dues and special assessment dues. Well, the condominium association may come in and put a brand new swimming pool in. Okay. Well, they're not going to charge property tax for that, or they're not going to put that in your monthly condo dues. They're going to charge you a special assessment. Everybody's going to contribute in building that new pool one time. Okay, so that's what special assessments are. All right, in case of a breach by the buyer, most real estate contracts include a provision that earnest money be regarded as what? Breach by the buyer. Real estate contracts include a provision that earnest money be regarded as what? Okay, what is that regarded as? Breach by the buyer. If the buyer breaches, the contract includes a provision for earnest money. We know that earnest money is liquidated damages, so A and D can't be the right answer, okay? We know we're dealing with liquidated damages. So it's got to be between, or excuse me, A and C. It's got to be between B and D. Well, if it's a breach by the buyer, it's going to be liquidated damages to the seller, right? Money damages to the seller if the buyer breaches, okay? Again, we talked about this earlier under specific performance and default breaches. Liquidated damages, money damages, failure to perform. When they reference earnest money, it's the deposit, okay? If the buyer breaches, the seller keeps the deposit. If the seller breaches, the buyer can get their deposit back, plus the seller has to match it as their recourse or penalty. And then we talked about specific performance and rescission. All right, the purpose of recording a deed is to what? The purpose of recording a deed. When we talk about recording a deed, what's the purpose of it? So we talk about deed recordation. We're talking about recording a deed. Remember, there's two types of notices that we give, actual notice and constructive notice. So when we talk about constructive notice, what are we talking about when we record a deed? We're giving what? Notice to the world, right, of that ownership of that property. Okay, notice to the world of ownership of that property. Okay, so that's the purpose of recording the deed, is to give world constructive notice. Another word for constructive notice, world constructive notice, is public knowledge. Okay, so there's public knowledge that who owns that property now. There's public knowledge on the loan or the mortgage lien on the property, so everybody can reference it through land records, and that's the purpose of recording a deed. Okay. Okay, is to give legal notice, give public legal notice. Now, actual notice is what is known between the buyer and the seller, okay, or actual notice only between the buyer and seller. So there is no public knowledge, and that does constitute a valid deed. I can buy your property and go close with an attorney, get the property transferred legally into my name, grantor to me to the grantee, you signed it over, I purchase it, bring you the money, and I got a deed. Well, I don't want the attorney to record it, then it's not constructive notice. There is no public knowledge. It's only actual notice between you and I. I can take that deed and put it in my desk drawer. It's still a valid deed. It's a valid sale, okay? But the purpose of recording a deed is to give the world constructive notice of ownership, okay? Acknowledgement is another way, another term used for legal title transfer. This is a free act and will. Okay, so there's no duress of signing property over. So it's called acknowledgement. All right. Which description is most nearly due north? You got to draw this out. This is a compass question. So what do you think the answer is? Which one is most duly or nearly due north? What do you think it is? If you see this on the state exam, what is most nearly due north? All right, let's go through this. One thing you want to understand when you're dealing with compass direction is compass goes in 360 degrees. In between each degree, you have 60 minutes, okay? In between each minute, you have 60 seconds, okay? So it's degrees, minute, and seconds is how it's written out, okay? Now, that doesn't have really much to do with the question, but it's some, content that you want to understand, some theory about compass direction. Now, here's the question in the yellow box. Which description is most duly north? And I've got 4 answers, so I've got to really draw and plot these out. Well, if I draw a circle and I put 0 degrees up north, like it has, 90 degrees out to the right, south, that's 0 degrees south, and then 90 west. Anything above the 90 west, 90 east is a north longitude. Okay, so it's north. Anything south is going to be south. Okay, so all my answers indicate north, so I'm above the east-west line. Now, what I have to do is orient myself to the true north, which is 0 degrees. Well, if A is 0 degrees and 30 minutes west, then I'm going to draw a line just west. If you see right here, you see up at the top, the very top number, that's my 30-degree west line. If I go to my next one, I say 0 degrees, 45 east. You can see I'm still 45 degrees east. I'm still on 0 degrees, but it's 45 minutes east, okay? So that's 45 minutes. 45 minutes is further away than 30 degrees. Even though it's east, it's still further away than 30 west. If I go 1 degree, I'm actually going 1 degree, 15 minutes west. I'm further west than my 0 degree, 30 west, because I'm 1 degree further, okay? And then 89 degrees, 30 east would be more down towards the east-west line. So the one that's closest to the northern, true north of 0 degrees is going to be A, 0 degrees, 30 west, okay? And the reason you have to know minutes and seconds is because that's what it comes down to. For example, what's the difference between 0 degrees, 45 east and 0 degrees, 30 west? Well, if you draw it out, you can see what the difference is. 30 minutes west is closer than 45 minutes east to the true north, okay? You see how this works? So you have to understand the concept when you plot this out. This is almost like a real estate calculation where you have to draw the circle, draw your due north, east and west, and then reference your due north in the minutes, okay? Because everything, your first two answers are going to be 0 degrees, but you're only coming left and right, east and west based on how many minutes. Well, 30 minutes is closer to due north than 45 minutes, okay? Really doesn't matter what either side is, whether it's west or east, it's closer, okay? And then 1 degree is further out west than 0 degrees, so that's going to be further away. And then obviously the 30-minute east is going to be way further away, okay? So you're going to have to take each answer and kind of plot it, all right, to get your idea. Unless you can look at it. If you can look at this and see, once you see the vision of the picture, you can now look at the answer and say, yeah, 30 minutes west is closer than 45. I know that it's got to be either A or B because they want me to go true north, which is 0 degrees. So I know it's got to be either A or B because I'm dealing with 0 degrees in those two answers. The rest of them is going to be further away than the first two. So between the first two, now I got to go to my minutes. What's closer to due north, 30 minutes or 45? And so 30 would be closer, okay? So we're talking about answer A. All right, the legal document that allows a purchaser of a cooperative to occupy a particular unit is referred to as what? The legal document that allows a purchaser of a co-op to occupy a particular unit is called what? What's that term called? In condominiums, you own fee simple, the cube in the sky. But what about a co-op? What does that give you? All right, so the legal document that allows a purchaser of a co-op, okay? So we're talking about a proprietary lease, okay? So let's look at co-ops. Remember, the corporation is the owner of the building. You as an individual will purchase stock in the corporation, and they allow you a proprietary lease of the unit. So you carry a share load of stock in the corporation, and that gives you a right to occupy the unit. Constructive possession, you get possession of the unit through a proprietary lease. Remember, the corporation is going to pay the property tax. Each shareholder is responsible for paying the dues, okay? Corporate dues, all right? Like condo dues to keep up the maintenance, okay? But here's the difference between condos and co-ops. Condos, you own fee simple of the unit. You have actual ownership. In a co-op, you're going to buy stock in the corporation that owns the building. They're going to give you a proprietary lease, okay? So the value of the building or the value of the unit that you're leasing, a proprietary lease, is going to be purchased through the stocks, right? So you own the stocks, not the actual unit, okay? But you get the lease. All right. An owner sold her home to a married couple, gave them a warranty deed. The couple moved into the home, but did not record the deed. Uh-oh, right? We just talked about constructive notice and actual notice. This is a good lead-in question. 2 days later, the seller died. and her heirs in another state sold the property without any knowledge of the previous sale. The heirs conveyed title to a single man who did record the deed. Who owns the property? You got to unpack this one now. This is hard to follow. So you got to go back and kind of line by line write down the scenario. So you have an owner. Watch me here. You got an owner. She sold the property to a married couple. One owner, she sold it to a married couple. Gave them a general warranty deed. The couple moved into the home, but they didn't record the deed. What did they do? They stuck it in their desk drawer. Who knows about the sale? The woman and the couple. That's it. Nobody else knows. 2 days later, the seller dies. Okay? So an owner sold her home to a married couple, gave them a warranty deed. The couple moved in the home, but 2 days later, the seller died. All right? So the seller's dead. And her heirs in another state sold the property. So watch this. The seller died, not the couple. The couple still has the property and the deeds in their desk. But the seller died. Now, that property after death went through succession. There's no constructive notice. There's no public knowledge that that house was sold to a new couple. So the heirs of the lady that died think, because they don't have evidence that the house has been sold, because it's actual notice, the couple has it in the desk drawer. So what they do is the heirs in another state, they sell the property without any knowledge of that previous sale. Why? Because the deed's in their desk drawer. Now, what happens after this is the heirs convey title to a single man who did record the deed now, who owns the property. Okay. Now, this is a real unrealistic case, right? There's probably more involved in it. You know, the guy's got to have seen the house. But what they're trying to do here is to get you thinking about constructive notice versus actual notice. What constitutes a valid deed? So who owns the property in this case? What do you think? And that's right. The couple does. It's the couple that owns it. It's a valid deed. It's a valid sale and a valid deed. Again, this is a real screw up if this ever went through, right? I can't see that it could ever go through. But what they want you to know, what the test writers want you to understand is what constitutes a valid deed, recorded and actual notice. So the couple does own the house, okay? And so here are the parties to the deed in review, a grantor and a grantee, okay? Remember, the grantor has to be competent, legal age, sound mind, must sign the deed over, okay? 2 witnesses must to attest to it, okay? The grantee does not have to be legal age or sound mind and doesn't have to sign for it to be a valid deed transfer. So here's the question again, and you guys got it right, the couple. Remember, the deed does not have to be recorded for it to be valid. And this is what they're trying to get you to look at. They're trying to say, look, you need to know that this deed was not recorded on the first sale. When the seller died, it went through succession and the heirs sold it, right? And transferred to a single man who did record it, okay? So it's still a valid deed from the original sale, the lady to the couple, okay? Requirements of a valid deed, just like contract law, it's got to be in writing, got to have the grantor and grantee named. Grantor has to be legal age, sound mind, got to have a price, consideration. Granting clause, that's the words of conveyance, okay? Legal description also of the property. The grantor's signature is acknowledgement, all right, which is a free and a free will and act of transferring the property. 2 witnesses, notarized, and then again, voluntary delivery and acceptance of the deed is when it's transferred. The grantee receives it, okay? So understand the principle of this. A deed does not have to be recorded to be valid, okay? Recordation gives public notice, okay? Constructive notice to the world. Actual notice is only between the people who actually know, okay? Both situations, valid deed. All right. The total amount of spendable income generated from an investment is called what? Okay. Spendable income. Okay. So you got investment property and you got spendable income. So we're not talking about leverages when you borrow money, somebody else's money. Equity is profit in a investment, right? That's what you what it's worth, and your actual current balance and your payoff now. So that's equity. Appreciation has to deal with real estate going up in value, right? Appreciates in value. So really the only one that fits this definition that says a spendable income that it can generate is called cash flow, right? Now you can have negative cash flow and positive cash flow, which is what you want, okay? But you can generate negative cash flow. A couple of terminologies you want to be aware of that you may see on the test when it comes to investments, and this is under the investment section. You know what appreciation means. Assets can be everything, including intangible and tangible. Tangible assets is what you can see and touch, like a building. Intangible can come in valuation given, like the name of a business, okay? A McDonald's versus, Joe Bag of Donuts hamburgers, right? So the McDonald's intangible name brings it a value, okay? Which can be part of the asset, okay? Cash flow, we talked about. That's the amount of spendable income, which was the answer. Equity, that's the market value minus the debt on the property. Leverage is when you use somebody else's money, okay? When you finance from the bank, you may put some down, and then you leverage out the rest, which is the bank's money, okay? So it's a loan. Liquidity is how quick you can get to that money and convert it to cash. Real estate is an illiquid asset, meaning you can't get money out of it fast. Unlike a savings account, checking account, stocks, investments, mutual funds, you can cash those in immediately. Those are liquid assets. So real estate is an illiquid asset. It is also considered a disadvantage for that reason. One of the disadvantages is because it's illiquid. Even though you may have a home paid off, it's still going to take time to get money out of it. You got to get it, loan approval. And you may not be able to get money out of if you don't qualify to pay for the loan, they're not going to refinance it for you. So you can see the illiquidity part of it, even though there's money available in it. And then capital gains is an adjusted basis minus the net selling price, right? So this is what you're going to pay actual capital gains tax on. All right. When a city or county government in Florida must collect delinquent taxes on a property, it issues a what? This is past paying it. This is past lien. This is past delinquency. This is actually when the property, Florida's collecting the actual delinquent taxes. They'll issue a what to the person that pays for the tax. Okay, it's at a tax sale. Okay, and that's right. It's a tax certificate. Okay, good. Very easy. Non-payment for real estate taxes. Okay, remember A, B, and C. You want to know for the state exam. Okay. Delinquent, April 1st, okay? The sales begins around June 1st of each year. And then this tax certificate is issued for non-payment. That's what a tax certificate is. It's given to non-payment for the one that pays the tax. Remember, it's not a property sale. It's a tax sale, okay? Now, a tax deed is a tax certificate awarded at a tax sale, okay? That's called a tax deed. The owner has 2 years to redeem the taxes and pay them. Okay, 2 years. After 2 years of non-payment, the actual certificate holder can apply for a tax deed. Okay, so there's a 2-year redemption to make good on it. So we're talking about a property tax certificate. All right, a nephew inherits his uncle's 1,150-acre cattle ranch. The legal term for the nephew in this situation is what? So what's the legal term? Who is the nephew? What do they consider? What's the nephew considered if the nephew inherits the uncle's 1,150-acre ranch? Okay, what are they called? Okay, all right, let's look at it. All right, so this is a section, if you want to take a picture of, this kind of breaks down, when it comes to acquiring legal title on a voluntary transfer. The term alienation means to transfer legal title to another person. So voluntary transfer is done through the owner's consent, a home sale. And we do that normally with deeds, right? We do a voluntary transfer. But also a transfer voluntarily can be made through a will. Remember, an owner dies, testate, that's prepared before death. So that's a voluntary transfer made to someone. So when the owner dies, the property gets transferred. But it's voluntarily made before death. Okay, prepared before death. Now, when we say testate, we're saying dying with a will. Okay, so the parties to a will who make it out is a testator and a testatrix. Okay, so this is the male that creates it or a female that creates it. Okay, and again, this is a will that's made out, voluntary transfer. The property to a will or a testate will, okay, the property is called a device if it is real property. If it's personal property like an automobile or motorcycle, it's called a bequest. Okay. So properties to a will, a devise is called real property and a bequest is for personal property. Now, the answer we're looking for is device C. These are the recipients to a will. So the question read, a nephew inherits 1,150 acre ranch. Okay. The legal term is a devicee. Okay. A devicee is the one that inherits real property, and that ranch is real property. Personal property is called a beneficiary. Okay. So we're talking about the individual, not the actual property itself. Okay. So we're talking about a devicee. If it was personal property, then it would be a beneficiary. Okay. So this can get really muddied up if you're trying to memorize it. What you need to do, maybe take a snapshot of this slide, because this lays it out in order, and we're talking about legal transfers of property. Again, reviewing a deed, that's normal transfer, grantor to the grantee. If a will is made out, again, that's prepared by a testator or a testatrix. And it's made out for real property called a devise, or it's personal property in the will called a bequest. It's made out to a devicee is called if it's real property, and a beneficiary if it's personal property. Okay. Does that make sense? Okay. Which factor is used in determining a gross rent multiplier? Which factor is used in determining a gross rent multiplier? Right? Gross rent multiplier. Remember, in theory, when we talk about gross rent multiplier, these are value for rental properties up to 4 units an appraiser will use. Remember, anything over 4 units is the income approach. You've got vacancy and operating cost. That's not used in the GRM or gross rent multiplier. Okay, it's only used up to 4 units, single family, duplex, tri, and a fourplex. No vacancies, no operating expenses. So what it is, and this is not a substitute for income approach. What it is, it's calculated using monthly rents. Okay. Now the formula is the value equals the rent times the GRM or the gross rent multiplier. Now they're going to give you 2 values or 2 variables in a real estate calculation if it's a GRM problem. All right. If you got 2, you can always calculate the third. Typically, they're going to give you the rent and the GRM. Okay, and they're going to just multiply it together, and that's going to give you the valuation of the property. Okay, so the formula is value equals rent times the gross rent multiplier. Everything is in monthly rent numbers. GIM, or gross income multiplier, again, bigger commercial properties that include rent plus other income sources, is an annualized number. Okay, so it's annual, not monthly for GIM. Okay.
For more practice questions, videos, and insight into the state exam, we encourage you to join our free exam prep webinar, How to Pass the Real Estate Exam Without Your Real Estate Book and with only 15 to 20 hours of study time. Click here to get registered.